Hello, my people. I'm glad to be here again. And today we are going to look at the topic working capital management. Working capital management. So, over some times now, for what we have been discussing under financial management, capital is very key to the survival of the business. It is even the life of the business. Without capital, there won't be business. But this, therefore, there's need to put adequate measure in place in order to do what to manage the capital that we use in running the business of the organization. And this, therefore, I'm going to talk about the topic working capital management today. To a layman, what is working capital? As the name suggests, the capital we use we work with. That's to a layman definition. If you want to interpret the definition according to the way we have seen it, is what to working capital. That is the capital we work with. So how do you now manage this capital in order to do what? To achieve the set goals. And what is the set goals of any organization? The set goal of an organization is to what? Is to maximize the wealth of the shareholders. So how do we now manage these resources, these financial resources called what? Capital, in order to achieve this set goals? By that, therefore, working capital under financial account, the ratio for our working capital is what? The formula for working capital is what? Current asset minus current liability. Okay, now looking at the definition given here for working capital. Working capital refers to that part of the firm's capital which is required for financing short-term or current assets such as marketable securities, receivables, and inventories. If you look at that very well, I said that working capital refers to that part of the firm's capital. The capital is the total of what? Of the finances of the company, what we used to do to run the business in total. But the part of this capital, which is required for financing short-term or current asset. What are the elements of this short-term and current asset? Elements are what? To cash, marketable securities, receivables, inventories. So that element of that portion of the firm capital, the total capital, which is used to finance short-term or current assets, is known as what we call working capital. So working capital is also known as revolving, circulating, or short-term capital. Because this is the capital that we don't know this is part of the capital, this is the portion of the total capital of the company that we turn around all the time, that we use in the daily operation of the company. So it is otherwise known as revolving, circulating, or short-term capital. So the primary purpose of working capital management is to make sure the company always maintains sufficient cash flow to meet its short-term operating costs and short-term obligations. So working capital management therefore requires great care due to potential interaction between its components. What do I mean by that? For example, extending the credit period offered to customer can lead to additional sales. However, the company's cash position will fall due to the longer wait for customers to pay, potentially leading to the need for a bank overdraft. So When you now go to do what? Seeking for what did that mean by what I just said there? There's need for us to do what? To adequately manage the working capital in order not to do what? Not to overstretch the process. In the sense that if it tends to do what? To extend the credit period offered to customer, which at the end of the day, it will lead to do what? It will lead to what? Additional sales. If you extend credit period of customers probably from 1 month to 2 months, definitely they will buy more. Customer will buy more because they are not going to pay immediately. They will tend to do what? To buy more. But the implication of what? Of that is what? The company cash position will fall due to the longer wait for customers to pay. Because if you extend the credit period, say from 1 month to 2 months, it means what? We will not see what? Enough fund. You will not see enough what? You will not be liquid enough for you to do what? To pay your what? To pay your obligations. Obligations such as what? Staff salary, the creditors, and other running expenses, because of the extension of the credit period from 1 month to 2 months. Because the customers will need to do what? To wait what? To enjoy a credit period of 2 months before they pay back what they have bought, before they pay for the goods they have bought from you. So, and in that way, therefore, you will now be looking for other sources of finance in order to meet up all these what? Obligations, short-term obligations in which you cannot do what? You cannot delay. In doing that, it now tends to do what? Probably look at what? At bank overdraft. And bank overdraft comes with what? With interest. If you do bank overdraft now, definitely the bank are there for business. Definitely they will charge you interest on that. You're going to pay interest on what? On that overdraft. So you should not overstretch the period, or you should not overstretch that. Okay, I want to report a large profit margin. I want to record a large profit margin. Tends to do what? To overstretch by what? By extending the credit period to customers. So working capital management is central to the effective management of a business. It's very key. A good knowledge of what? Of working capital is very key to the organization, because if there is a mistake, if you cannot do what? Combine, you cannot turn around what? This working capital, or you allow the working capital to be stocked up either with the customers due to the extension of credit period, then the company will be in great jeopardy, because you won't have enough fun to do what? To embark on your day-to-day running activities of the company. So working capital management is central to the effective management of the business, because current assets comprise the majority of the total assets of some companies. So shareholders' wealth is more closely related to cash generation than accounting profit. So extension of what? Shareholders' wealth is more closely to do what? To cash rather than accounting profit. If you are looking at accounting profit, it's a function of what? Of your sales and cost of sales. From there, you move what? Operating expenses, you have your what? Accounting profit there. What the sales that you are talking about here is combination of what? Of credit sales and cash sales. So if you extend the credit period to what? To the customers from 1 month to 2 months, fine, you are going to do what? Record the last sales, but that sale does not translate to what? Does not translate to cash to you, which in turn is not what? Is not in tune with what? With wealth maximization of what? Of the shareholders. So failure to control working capital and hence to manage liquidity is a major cause of corporate collapse or failure. So management of working capital include cash management, inventory management, and management of account receivables and account payables. So management of working capital involves now go ahead and say that I want to management of working capital. So management of working capital involves cash management, account receivables, inventory, and what? Account payable. So for you to effectively manage working capital, it involves what? Management of working capital. So management of working capital here involves cash management, account receivable management, inventories, and account payable management. So if you can appropriately manage this component of what is at the value area, that what is our working capital. Working capital is current asset and current liability. So in accounting terms, in that ratio form. So management of working capital involves cash management. You need to do adequately manage your cash. We are still coming to that. We are going to treat management of cash. So account receivables. What is account receivables? Your debtors. Those people that owns you. How do you manage them? Inventory, your stock. Inventory stock can be stock of raw materials, stock of finished goods. Account payable. What's account payable? Those people that you bought on credit from. So by this, therefore, account receivable and account payable, we are not talking about a particular cycle that involves around. Where does production start from? Account payable. You buy your raw material from your creditors, that is account payable, and you use you transform the account payables to inventory. Raw materials, you transform into work in progress into inventory. Inventory can be inventory of raw materials, inventory of work in progress, and inventory of finished goods. So when you say inventory, it can comprise of three things: inventory of raw materials, inventory of work in progress, and inventory of finished goods. So when you bought on credit from your creditor, which now translates to account payable, you have your inventory. When you have transformed it to work in progress to finished goods, you have your inventory. And then therefore, you now sell that inventory, which is stock, you sell it to your customers in forms of it will now become account receivables. So it is account receivable that will now transform to cash. When you now receive cash, when your customers pay, or now receive cash from your customers, and in turn, it's now coming back to do you now use to do to pay your creditors, those who you two have bought on credit from. So you can now see that proper management of working capital is the soul of any business. If you give a credit period of 1 month to your debtors, definitely your account payables, you should have also received at least a 2 month or 1.5 months from your creditors, so that by the time you are going to receive this money from your account receivables, then you will have by the end of the 1 month period, you granted to your customers who bought on credit from you, will have enough money before the expiration of the credit period given to you by your creditors. So you need to know how to manage the working capital. That is how you call it working capital management. You need to know how to manage the working capital in that sense, therefore, before you can do adequately provide for all this without one falling short of what of the other. So the company may tend to do what to have what excess cash or what shortage of cash. There's need for what that's what we call cash management. When the company is tending to do what to be carrying what too much cash at hand, it can do what to it is advised it can sell it can bought what securities, short-term security, marketable securities. So yeah, that's what we have talked about, what I spoke about here, marketable securities. If the company is highly liquid, that is having enough more than enough cash, so it can tend to do what to invest what the cash, the excess cash in what in marketable securities. And when there is need for what to for cash to run the business, when there's shortage of cash, it can tend to do what to dispose the marketable security and what and come back to what and have cash in order to run, keep running with our activities. So adequate knowledge of working capital has a long way to do what to the survival of the business. As a finance manager, as an accountant, as a finance director, an adequate knowledge of what of working capital, of adequate knowledge of working capital management is highly required, is central to the success of any business. So basically, what are the key objectives of what of working capital management? The key objective of working capital management will be discussed in my next video. Just watch out and see what is the key objective of working capital management. What do you want to achieve? What are the objectives for having a good management of working capital? So watch out for my next video. I shall treat the objectives of working capital management. Thanks for listening and God bless.